Okay. Now, today we're going to continue with stockholders' equity. And we went through, I guess, just some of the basics, and we talked about the objectives of accounting for stockholders' equity. It's primarily a disclosure objective where the sources of capital have to be disclosed, and of course the contracts or any rights or agreements that would impact the rights of the common stockholder. Now on page 2, we know that we have two classes of stock, common known as ordinary shares and preferred known as preference shares, and regardless of the class of stock, you're going to find that there are detailed disclosures either in the footnotes or in the stockholders' equity section. You usually see the terminology authorized, issued, and outstanding. And the authorized shares are the number of shares that you could legally issue. Those are the number of shares that are reported or included in the corporate charter filed with the state. Issued shares are the shares that have been either sold or distributed to the stockholders, and the outstanding shares put the word shares in here. The outstanding shares are, for us, the most important because that is going to represent the number of shares that were used for earnings per share, dividends per share, etc. And these are issued minus Treasury. And I know that you have seen Treasury stock. That's when the corporation buys back its own shares for some particular reason, probably to use to raise market price, to distribute in employee stock purchase plans, and the like. Now, very simple example. On page 3, you'll see that if I have 10,000 shares authorized and 80,000 shares issued and 1,000 shares in the Treasury, we know that there are 7,000 outstanding shares. So in this case, I issued 8 with 1 in the Treasury. I've got 7,000 outstanding. Pretty simple. If I calculate earnings per share, it's based on outstanding shares and so on. Treasury shares are not active. Treasury shares can't vote, and they can't receive cash dividends. So again, the importance of knowing the outstanding shares. The other shares are unissued. Now the unissued stock is not important for accounting, so you had 10,000 authorized, you issued 8, so the other 2,000 are unissued, not critical from an accounting standpoint, but from a finance standpoint, clearly you need to know how many shares are still available to be distributed to the marketplace. So again, when we look at the outstanding shares, it's one importance, or the one importance of that is that you've got 7,000 shares that could receive dividends, 7,000 voting shares, 7,000 shares that we're going to use in earnings per share and cash dividends per share. When you think about the unissued shares, these are the shares still available to be issued to raise more capital. Now, of course, you can go back to the state and get a new authorization. You could do lots of things to increase that number. Now, looking at the disclosures, and we said disclosures are all important for this chapter and for this section of the balance sheet. This is ACE Limited. It's a Swiss company traded on the New York Stock Exchange, and it is, in fact, showing you a stockholders' equity section that has lots of important components for us. First of all, we talked about the 3 components, and those components are contributed capital, And that consists of common stock, shares in the Treasury, and additional paid-in capital. Second, we have retained earnings. Which we defined last Thursday. And then, of course, we have accumulated other comprehensive income. Now, one of the things you'll notice here is the number of shares authorized and not disclosed. Typically, up here, where it says common shares, you'll see authorized shares as well. You'll also notice that the way they treat Treasury stock is one of the options we'll talk about probably on Thursday, which is known as the par value approach or the constructive retirement approach, where the shares in the Treasury are shown as an offset to common stock. Now, somebody asked me the question about this. They were a little confused about it, and the way I always address the issue is to really raise the question with someone who's never seen accounting before. If you walk up to someone and say, if I issue common stock, what happens? Cash comes in, common stock goes up. What do you think happens when I buy the stock back? Cash comes out, and treasury stock, and the treasury stock reduces the common stock. So technically, this is the right way to do it, where the treasury shares reduce the common shares. And if you notice in here, if you look at the numbers, if you take the number of shares that are issued, and if you subtract the treasury, you're going to get the number of outstanding shares. So if you take the 341,094,559, which are the shares that are issued, and the treasury stock, and subtract that out, you're going to get the shares outstanding. So the shares outstanding are 334,942. So issued minus treasury will give you the outstanding stock. And that's part of the disclosure here. Now, one last point, which I'm going to get right back to, is in here, deferred compensation. What I want you to notice on the deferred comp is two things. One, the $2 million that's in here offset completely. So you notice that there is a debit in stockholders' equity, common shares issued to an employee trust, and a credit to deferred compensation obligation. You got to watch the terminology. That is not a liability. These are compensation contracts, like deferred comp contracts, stock options. In a few minutes, I'm going to show you stock subscriptions that operate this way. This is a disclosure device that will indicate that shares will be issued. This is not an obligation. Essentially, it is a disclosure that indicates the company will issue common stock later. It's not a liability, otherwise it would be in stockholders' equity. And just one last point here. This could be disclosed without making entries. So what you see here is a very strong form of disclosure. This is not mandatory. Companies have the option to just put this in a footnote. Why? It washes. It's a zero effect. Now, we'll get back to this in a few minutes when we take a look at stock subscriptions. All right, so there's your stockholders' equity section. That's a classic example of a stockholders' equity section. Okay. And it has the three components: contributed capital, retained earnings, and comprehensive income. And it also has a couple of other things that we need to explain further. Yeah, Nick?
The authorized shares that you have 10,000 authorized shares, 1,000
Right.
Where's the other 1,000?
The good question, because what he's saying is you've got 10,000 authorized, 8,000 are issued, 1,000 in the Treasury, 2,000 are unissued. The question, I think, tell me if I'm wrong, is there any relationship between unissued and Treasury? No. Treasury are still considered issued shares. They're still issued. And that's the good thing about Treasury. because I don't have to get an authorization. I don't have to get any type of registration, pre-registration. Even if I do a shelf registration with the SEC, I don't have to go to the New York Stock Exchange. I have those shares. I can distribute them tomorrow because they're still considered live. They're still issued shares. Now, we're going to see later on when we get to the third module that another way to handle share repurchases is to call them retired. If we retire them, we put them back into unissued. So the question is a very good one, and it's sort of a little turning the corner a little bit, but we'll get there. So Treasury stock is still considered issued. It's sort of although it's not active right now, I could activate it by just selling it. I don't have to register it again. It doesn't have to be registered. It's still issued as far as the organization or the exchanges are concerned, stock exchanges are concerned. Any other questions? Yes. Yeah, what happens here is that what companies will do, this common shares issued to an employee trust, this is almost like a deferred expense. So we'll see this when we do the stock options, but what the company does is they'll debit, let's just call this common shares in the trust. And that's sort of like a deferred comp expense. And we credit this deferred comp obligation. That's negative equity, that's positive equity, it zeroes out. What happens is that over time, this gets amortized to comp expense. So let's say they take one a year. So next year they'll amortize that. And then this eventually would go to common stock. So you're paying somebody in shares, but they need to earn it over time. So let's say I give you a employee bonus plan or bonus stock option plan. You have to work 2 years to get it. So right now it's deferred, but every year you work, you get 1/2. It's over a 2-year period. Let's say you have to stay with the company for 2 years. And that's the way it works. But we'll see that in more detail later on. It's a deferred comp plan. And by the way, you don't have to make the journal entry. You can just disclose this because notice negative equity and positive equity is zero. It zeroes out in the equity section. Yeah, a footnote is more than enough for this, but what some companies will do is they'll put it on they'll make the journal entry, put it on the balance sheet because it's a much stronger form of disclosure. If you think about it, how many of us read footnotes even in textbooks, right? So a lot of people, when they look at the balance sheet, it really hits them and says, okay, I got deferred comp here. And what's the most important thing is the potential dilution of earnings per share, because eventually that deferred comp obligation will become common stock, and it's going to dilute your interest. It's going to hit the market lower stock price. So that's the main reason for the disclosure. And I'm glad you asked the question because technically it's like everything else in this chapter. Everything we do is designed for disclosure purposes. All right, any other questions on the balance sheet? Yep, bro. Yep.
Does that price already reflect the drop in share price that will occur from dilution, or does it drop further?
It will drop further. I mean, you go to market with an IPO. That IPO price is the price that people are going to buy that stock at. And then, of course, it depends on the market signal or the reaction. So I think, was it Facebook, when it hit the market, people started selling rather than, on that IPO. So if they go to market with a secondary offering right now, that will hit the market, and if people see that as a positive signal, everyone goes in to buy, and they may buy from other investors, not only on the IPO, and it could raise the price. It depends on the signal that is sent by the share offering. And that's why we'll see in this chapter, when we look at preferred stock, during the recession, lots of companies would issue preferred rather than common, because preferred doesn't dilute the interest of the common stockholder. Because debt, forget, I mean, you're not going to buy debt in a market like that because you're concerned about the company's ability to stay in business. And common stock, if you issue common, you dilute the current shareholders' interest even further. Shares were selling way below book value anyway, and that would make it even worse. Okay. All right, any other questions? Now, another statement that I think we tend to overlook, if you go to page 4, you'll see that we have a statement of stockholders' equity. This is really a main or a major financial statement. This is known as the statement of changes in stockholders' equity. In accounting 1 or in your basic accounting class, what did you call it? Basically a statement of retained earnings, correct? This is a statement, first of all, that is considered a flow statement. So you have 3 years. On a flow statement, you always get 3 years. And it explains the change in every line of the balance sheet stockholders' equity section. So the purpose of the statement of stockholders' equity is to explain changes in the stockholders' equity section. So that when we look at the common shares, the beginning of the year, the shares repurchased, and shares that were redeemed, additional paid in capital, beginning of the year, various activity, and then the ending balance. Retained earnings, same thing, beginning of the year, and you would expect that you would have net income, obviously, minus dividends. So these are other adjustments that go through the retained earnings section. So every change in the balance sheet account is explained. In comprehensive income, and there's your deferred comp. And you notice that, just getting back to your question, the deferred comp was amortized in the prior period, right? As it's being earned. And then, to me, the most important thing is for you to see the comprehensive income section, because that explains the sources of comprehensive income. As we said, these are items that are not on the income statement because of volatility, not part of normal operations, and they have a very low probability of realization in cash. So the translation adjustment, you have the unrealized gains and losses on securities, and the pension adjustment. So this company, the reason why I picked this company, it's got all 3 of the possibilities. So first, it's got unrealized gains and losses on investments. It has the cumulative translation adjustment. So it started off at 240. There was a gain of 22. Now it's 262. I think the numbers are really helping you understand, or will help you understand, why we keep this off of the income statement. I mean, just take a look at the volatility here. I mean, the balance here, and even these changes, look at the change. There's a loss in 2008 of $2,302,000. Then there's a gain of $2,611,000, and then another gain of $742,000. On the translation, on the foreign currency, there's a loss of $392,000, a gain of $401,000, a gain of $22,000. So the numbers are all over the place. It's extremely volatile, and that's one of the reasons why we keep it off the income statement. And the same thing is true with the pension adjustments. And of course, think about it, the only way that this gain of $22 million will be realized is if I sell off my subsidiary companies. And again, we explained that would be like having a sub in a foreign country, in order to get the gains in dollars, you'd have to liquidate the sub, take the foreign currency, translate it back to the dollar, and then bring it back to the U.S. So the probability of that happening is very low, and as a result, we keep these off of the income statement. So other comprehensive income is going to be kept off of the income statement for those reasons. And also, please, when you have a chance, go back and see how this ties back to the balance sheet. So the 1594, that should tie right back to the balance sheet. So the 1594 on the statement of stockholders' equity, if you go back to page 3, should also be the 1594 you see here with the arrow back on the stockholders' equity section. So every line item is explained on the statement of changes of stockholders' equity. Now again, nothing to memorize. You have to memorize line items on those statements, but just realize that's where you're getting information to satisfy the disclosure objectives. I'm explaining to you exactly how each of the accounts in stockholders' equity have changed. Now, other disclosures which are important are on page 5. And these disclosures are recommended by the SEC. They're not required, but they're recommended. And you'll have information about security repurchase plans or buyback plans. You'll also have restrictions on common stockholders and dividends declared. Now you have to, I should tell you that you must disclose dividends declared, but dividend policies like statements like the company has paid $1.30 in dividends consistently for the last 15 years. So policies are recommended by the SEC. They're not mandatory. And the reason why they're recommended is because it really injects lots of stability in the market. It gives investors confidence, and in fact, the investors, and I say this later in the notes, investors place a premium on companies that make such disclosures. For example, if you look at their repurchase plans, first of all, the board authorized $600 million of share buybacks. And Apple did the same thing. About 3 months ago, I think it might have even been at the end of 2013, they announced a program that they called Return of Capital Program to shareholders, bought back tons and tons of Treasury stock. So you buy back the stock. Why? Could be to support market price, and it also gives investors confidence. They'll know that you'll buy back the stock if the stock starts to drop. So it really gives the shareholder a positive impression of a company that buys back Treasury. Now, do you have to buy back all 600 million shares? The answer is no. You don't have to buy any. It's just a policy that was agreed to. Whether or not you buy them back, it's up to the company. It also helps the market in a sense that they know when the company goes in to buy the shares, they know that it's anticipated. So it gives some sense of stability in the market. In the restriction side, this is basically saying that if you own common stock and you have a 10% voting block, you'll never own more than 10% of this company. Why? Because every time you buy shares, all of your shares will be, the voting rights will be reduced so that the total will be 10%, no matter how many shares you hold. The SEC, by the way, considers a voting block or a voting control, a control block, I should say, at 10%. And then, of course, the dividends. So, again, as I go on to tell you that these disclosures are recommended because they help stabilize stock price, and really, companies that make these disclosures are favorably viewed by the market because of the injection of stability in the market and also confidence that the company would buy back shares during economic downturns. So again, it does give a sense of stability. It gives a sense of value for these types of companies. But again, aside from the fact that you have to disclose the dividends declared, all these other policies are, for the most part, recommended by the SEC. And again, the disclosures are designed, as we mentioned, to be sure that you indicate any contracts or events that would impact the rights of common stockholders. Okay, any questions on the disclosures or anything, just in general so far? Okay. All right, first thing, before we even look at some journal entries, you should know that, of course, from shares typically have a par value, and par value really is nothing more than an arbitrary amount that's placed on the stock when the shares are authorized with the state. It's in the state corporate charter. The par values were used originally, as I tell you in the notes, to satisfy what were known as minimum legal capital laws. These laws no longer exist, but that's how we started with par value. And now that par values are here, we still have to account for them. So what does minimum legal capital laws tell us? Back maybe 120 years ago, in the early days of corporate formation, if all of us got together, incorporated ourselves, and then paid a dividend that bankrupted the company, we wouldn't be liable. Why? Because the corporation was seen as a separate legal entity. Even worse, what if we borrowed money from a bank, paid money to ourselves as dividends, and walked away? So minimum legal capital laws were designed to protect creditors, and you had to leave in the company minimum legal capital, which was specified as par. In fact, if you bought stock at a discount below par and the company goes bankrupt, you could be liable to pay that back to the company in the case of bankruptcy. So it got a little bit interesting when you had minimum legal capital laws. Why were they now, I guess, ineffective? Minimum legal capital laws are no longer effective because right now the courts will what they call pierce the corporate veil. You might have seen this in business law where, you know what, yeah, you're a corporation, but what you did was fraudulent, so we don't care if you're a corporation. Every stockholder is liable. So you don't need par values anymore. And in fact, even when we had minimum legal capital laws, if you were a manager, what would you do if someone said you had to leave par value in the company to protect creditors? You make the par value a penny, right? So the par value became somewhat meaningless, and therefore most states today allow you to issue no par stock. And when you have no par stock, you could have either true no par or no par with a stated value. Now, no par stock means that there's no par and everything you sell, the full amount of the proceeds of the common stock goes into the capital stock account. What is a stated value? Stated value is, once again, an arbitrary amount placed on the stock by the board of directors by a board of director resolution. Now, for us, the debits and credits look exactly the same as par value. So if you have a stated value, if you have a par value, the debits and credits are identical. What's the difference? Legally, a stated value can be taken off, can be changed if the board of directors decide. A par value is much more legally stringent, where you've got to go back to the state to change the par value. Now you might say, well, wait a minute, this doesn't make any sense. Why why even have no par stock if you're going to put a stated value on it? Well, again, stated values are a lot more flexible. You can change them. But why do you want it? Well, you use a stated value to generate paid-in capital in excess of stated value. So what will happen is that this will act just like a par value. Stated value and a par value will act exactly the same. It will create additional paid-in capital. And that's sometimes known as capital surplus. only reason that I ever was told that you would want to create surplus by having, and again, any amounts over par or stated value. Amounts over par or stated value create surplus. If you have surplus, you could pay dividends out of capital surplus in some states. Those dividends are not taxable. So that if you pay dividends out of surplus, it is a tax-free dividend, unless, of course, the dividend exceeds the market value of the stock you hold, which probably won't happen. So you create surplus with a stated value, just like you would with a par value, but a par value legally is much more restrictive. So the stated value does the same thing that a par value does, except that it has less legal restrictions. And of course, the terminology that we use when we pay a dividend out of surplus is called a liquidating dividend. A liquidating dividend is a return of your own capital, and it's not taxable. So that's one of the reasons why we have a stated value. Now, a liquidating dividend, you have to watch the definitions. I mean, for us, I'm using the term liquidating dividend as any dividend not paid from retained earnings, paid out of surplus. In some books or in some financial dictionaries, they'll tell you a liquidating dividend is a dividend that is paid when retained earnings is zero. But for us, any dividend paid out of surplus is called a liquidating dividend. And why surplus? The term surplus exists because it's over and above what? Legal capital. So technically back, and again, it's not effective today, but back when these laws were really in place and very, very stringent and effective, par value, you had to leave in the company, you couldn't touch it. Anything over par was surplus, you could do with it as you wish. And that's where the terms come from. And just to give you another term, sometimes you call retained earnings earned surplus. You might see that term, earned surplus, for retained earnings. Okay. Now, finally, just one last point before we get involved or take a look at, and again, there's the rationale why you might want to issue stock at no par and then put a stated value on it. And for our accounting, it doesn't really make any difference. Par value and stated value look exactly the same. Now, the one last issue before we look at some journal entries is stock issue cost. Anyone remember what you do with bond issue costs? How do we treat bond issue costs? Chapter 14, long time ago, December. In fact, the last class, I think we covered that. Or one of the last classes. Was that? You probably should expense it, but GAAP right now calls it an asset, a deferred charge. Bond issue costs go on the asset side of the balance sheet. I don't know if you remember, the IFRS treatment's much better. IFRS has the bond issue cost as a reduction of the proceeds when you sell the bond, so that will either increase the discount or reduce a premium on a bond. And it changes the effective cost of borrowing. I mean, just think about it. If you sell a bond for $100,000 and you got to pay $10,000 of bond issue costs, you only have $90,000 to use, your cost of borrowing goes up. Under IFRS, they calculate a new interest rate. Makes sense. US GAAP, we create an asset. The theory is that the bond issue costs were needed to raise the capital, and that capital benefits you over the bond term. Now, stock issue costs, same idea, except that the treatment I think makes more sense. Stock issue costs are typically reduced additional paid-in capital on the sale of the stock, and that's the most common approach. Another approach you can use is similar to bond issue costs because you create an asset. And usually this case is when you first start up a company, when you first create a company and you issue equity capital. The cost of that equity capital is considered an intangible. Once again, what's the argument that makes it an asset? It's got benefit over future periods. That's probably an indefinite life intangible because the life of the business is indefinite if it's a going concern. But as I mentioned in the notes, not only is this recognized by the SEC, but the IRS allows you to amortize organization costs over a 5-year period, and a lot of companies do that. You know, depending on the materiality, this intangible asset will probably be amortized, but we can make an argument that it's an indefinite life intangible, and indefinite life intangibles are what? Not amortized. So this is very similar to the treatment of debt issue costs. You create an asset. All right, now, any questions on the stock issue costs? I'm going to show you some entries in just a moment. Any questions on the notion of a stock issue cost? Same thing, underwriting fees, legal fees, whatever you're paying to have the stock issued. Any transactions costs that are involved in getting the stock in the hands of the shareholders. Okay. All right, let's see how it works then. If we issue stock for cash, if you now take a look at page 8, you'll see that I have two possibilities. One, I want to know the entry if this is true no par stock and you issue it for 1,000, which, by the way, is exactly the same if you issue a stock at par or at its stated value. All of the proceeds go into the capital stock account. Capital stock is a generic term for equity. It's either common or preferred. So in entry A, which you could see, if there are cases without, or if this case has no par value, everything goes into common stock. Debit cash, credit capital stock, cash flow from financing activities. It's also true that if you issued at par, you notice, if you issue it at par or stated value, it's going to give you the same result. Everything goes into the capital stock account and you don't generate any surplus. So as I said before, with true no par stock, you don't generate any additional paid-in capital, nothing in excess of par value. Now, in the event that there is a par value, and we're not going to do anything with bond stock issue cost right now, in entry B, if there is a par value, and the par value is 400, or if the stated value is 400, you debit cash from financing activities for 1,000. You credit common stock at par or stated value. So it's exactly the same debits and credits if it's a par value or a stated value for 400, and the excess of 600 goes into the paid-in capital in excess of par or paid-in capital in excess of stated value. Now, internally, as we said, every source of capital has to be kept separate. Why? Certain states have different rules with respect to what you could do with excess over par, with excess of stated value. For example, in some states, excess over stated value also becomes minimum legal capital. So there are some minimum legal capital laws that are still in effect. So internally, you would have to label this as paid-in capital in excess of par or paid in capital in excess of stated value. Any questions on the first two entries? Again, there should be a review of the basics. It should be, but if not, let me know. Okay. Now, something you probably didn't deal with, or you might have dealt with, depending on where you took the basic accounting, is going to deal with the stock issue cost. And here are our two possibilities. Let's assume you go to an underwriter to float the shares. The shares will sell for 1,000, but they'll only give you 800. They're going to charge you 200 for their services. That 200 reduces the proceeds, and the question is, how do you handle the stock issue cost? The stock issue cost can be treated either as a reduction of additional paid in capital, which is the most common approach. Or we can create the intangible if this is a startup enterprise. So let's take a look at the first case, entry B, with the stock issue cost that we're going to use to reduce additional paid in capital. So in this case, we're going to debit cash for the amount we received, the 800, credit cap stock at par or stated value, and the difference is now going to be for 400. The original paid in capital was 600, but now we reduced that by the stock issue cost. So stock issue costs are going to be a reduction, in this case, of APAC. Now the other option, of course, is to create the intangible, and you capitalize them or defer them just like you would do the bond issue costs, and in this case you still leave the underwriter with 800 in cash, but now you create an asset for 200. So the debits for cash of 8, organization costs, which we'll consider an intangible, is going to be 200, and cap stock is credited at par, and additional paid in capital does not change. It's the original amount. So the $1,000 original price of the stock minus the par is still going to give you surplus of 6. It does not change. Or, of course, you could just plug this amount, because the total assets you have here are going to be 1,000, 800 in cash, and you create a $200 asset. And, of course, the difference between the 1,000 and the 400 in par creates the surplus. Yep. The benefit in this case, it's up to the company, because in this case, if it's a startup enterprise, it's part of your organization. And it sort of makes some sense to do that. There's really no economic benefit except that it preserves surplus in case it allows you to increase your capital, so that if you wanted to, you have more equity that could be used to distribute the dividends. So if you pay dividends out of surplus, this does kind of preserve some surplus. It doesn't erode any capital for the company, whereas the first treatment to reduce APEC will erode the company's capital. But there's really no true economic or real benefit, because you got the same amount of cash. And that intangible is specific to the company, like goodwill. And I'm sure if this company was up for sale, nobody's going to pay for your organization costs. Right? It's an intangible. It's probably worthless to another buyer. So it has no real benefit, but cosmetically, it does allow for a higher stockholders' equity, and it also allows you to generate more surplus in case you want to pay dividends from surplus or from paid in capital. Okay. Yeah?
Just don't see where the surplus is coming from if you paid out the cash.
Oh, because you have this asset.
Yeah, I understand that asset has no cash.
Right, exactly. And that's
Where are you generating dividends?
dividends has nothing to do with cash. Because the same thing could be true. You certainly don't have enough you certainly don't have enough cash to cover retained earnings. Right? There are other assets that make up the package of the company. As I said here, this is more cosmetic than anything else, because that asset has really no value. So that's why I think the more common approach and the preferred approach is here. to reduce paid-in capital. But you make a good point. But I just wanted to clarify the comment. You do not need cash equal to retained earnings to distribute dividends, just like you don't need cash equal to surplus to pay dividends out of paid-in capital. I'm sorry, could you start that over again? Could you? Well, I don't know. I mean, if you started on, are you saying that, let me make sure I understand the question. If you started to sell stock and you issue shares on IPO and you use reducing paid-in capital, then you have a secondary offering, you set up an intangible? Probably not. The other way to do it may be true. When you first start your company, you may set this up as an organization cost, as a cost to an asset that you needed to help build or at least get the company going public, or at least issue stock, even if you issue those shares internally. After that, if you wanted to reduce APEC going forward, it would make sense. Yeah. It would make sense to do that. Okay. All right. So that's issuing stock for cash. Issuing stock for cash. Any other questions on issuing stock for cash aside from the organization costs and the stock issue costs? Should be fairly, or repeat at least of something you saw in the intro. Now, something I know you have not seen, and that's going to be subscriptions. And subscriptions, like almost everything else we do in this chapter, is really designed to set up what we need to know for earnings per share. This entire chapter is really going to be an introduction to what we need to be able to handle the earnings per share coverage and the stock options. So chapter 16 gets involved with lots of financial instruments. So we're going to look at a lot of convertible bonds and different types of hybrid securities as well. Now, what is a subscription? The stock subscription first of all is a contract. And that contract is between a corporation through an investment bank or an underwriter and potential shareholders. You could have general subscriptions or restricted. A general subscription would be something that, or cash subscriptions as they're called, would be something that you would use on an IPO or a secondary offering. In an investment bank, the investment bankers do roadshows. They'll go out to mutual funds, hedge funds, pension plans, and pitch the stock. They try to get subscribers. They try to get mutual funds, pension plans to agree to buy a block of those shares. Those are known as general subscriptions. Restricted subscriptions, for example, would be an employee stock purchase plan. You work for Johnson & Johnson. Johnson & Johnson offers you the opportunity to buy the stock and have money taken out of your paycheck every week to invest. Those are known as restricted subscriptions. Now, the question becomes whether or not we need to make any journal entries. We certainly need to make disclosures. Why? Because subscriptions are future potential issuances of common stock, which means that they are potentially dilutive. Going back to the basic framework of this chapter, we have to disclose events that could impact the rights and the possible dilution of the common shareholder interest. So these have to be disclosed. Now, the way we disclose it could be one of two ways. We can make either a footnote or we have an optional journal entry. Now, this is exactly, or it's going to parallel accounting for employee options or non-cash, or I should say share-based compensation. Here's what can happen. On the date the contract is signed, the mutual fund, the hedge fund, the subscriber agrees to pay a certain amount. So we debit stock subscriptions receivable. Corporation common or capital stock will credit unissued common stock or capital stock subscribed at par or stated value, and they'd also credit any additional paid in capital if it's in excess of par value. Now, this looks like relatively simple and not very controversial, but there is a couple of questions that we have to address, or there are a couple of questions we have to address. First of all, when we think about this, this is the receivable that is a promise from the subscriber. The unissued common stock subscribed, this is where, and I know I'm glad you asked that question before, when we looked at ACE Limited, we saw that there were, or the term on the stockholders' equity section was what? Obligation. This is not a real liability. It's sometimes looked at as an obligation, and sometimes in the stockholders' equity section, you see the term obligation. We saw it a couple of minutes ago in the case of ACE Limited. So in some cases, you actually see the term obligation sitting there. Now, the question is whether or not you have to make that entry. Well, first of all, let's think about the receivable. The key accounting issue that you see here on page 9 is that the Securities and Exchange Commission does not consider this stock subscription receivable to be an asset. Why? A couple of reasons. Number one, the contract is not legally enforceable. So in other words, I can't force you to become an owner of my company. Just like I can't force you to become a partner in my company unless I could prove that your change of heart is going to affect me monetarily for damages. So that the receivable is not enforceable. And it's also not part of normal operations. And on top of that, if you look at the textbook, it tells you, depending on the state, if you gave deposits, some states require that you get your deposit back. Other states are going to tell you, corporation can keep it. It's donated capital if you back out. In other states, they issue fractional shares. So the issue for us is that just like this unissued common stock subscribed is not a liability, this is not an asset. It's not part of normal operations. It's not enforceable. Not legally enforceable. Okay. And therefore, all of this leads to the conclusion is the uncertainty as to collection. So the Securities and Exchange Commission says that this cannot be an asset. Where is it? It's negative stockholders' equity. So the subscription receivable is negative equity. Unissued common stock subscribed is not a liability, it's positive equity. We saw that in the ACE Limited case, and APEC is positive equity. So that, what is the effect of that journal entry? The debit equals the credit, so it's got zero effect. It's an optional entry. You do not have to make that entry. You have to disclose it, but you don't have to make the entry. Now, on the balance sheet, however, as I said before, in response to your question, it's a much stronger form of disclosure. So now if I go on the income statement and I see a negative receivable, I see unissued common stock subscribed, or the obligation to issue stock, it becomes much, much more transparent that there is dilution here, or potential dilution. So these shares are potentially dilutive. Now the same thing is going to be true with employee options. Now again, not that I'm saying that stock subscriptions are not important, but the most important piece of this for me is to set up the accounting for employee stock options. So for me, the real issue for your understanding is to see this and then see how it relates to employee options. Again, these are potentially dilutive and have to be disclosed. If you don't make the entry, you have to have a footnote. Yeah, if the entry is not made, you have to have a footnote to disclose that you're going to have potential dilution. Once this information hits the market, it's going to have a potentially dilutive effect. All right, so now let's see the journal entries. And I will tell you, by the way, that I normally like you to make the entry here and also to make the entry for employee options. So here's what happens. Very simple case. You sign subscriptions and the price is $1,000. The par value is 6 and the excess over par is 4, and the stock subscription receivable is negative equity. The unissued common stock subscribed is not a liability. It's a promise to distribute, but there's no legal enforcement based on the 3 bullets you see on the board. Not part of operations, not legally enforceable. Collection is uncertain as to the receivable, so it is negative equity. It's not an asset. There is one exception. If it's collected during the post-balance sheet period, it's an asset. What's the post-balance sheet period? Anyone remember? Took auditing? It's the year end is December 31st. Annual report released sometime in February or March. It's the period between year end and the release date of the annual. So if you collect it during the post-balance sheet period, it's the only time that could be an asset. And the most important thing is that you can typically only issue the stock if you have full collection. So just think if you're working for J&J and they're taking a couple of bucks out of your salary every week, they're not going to issue fractional shares every week. They're going to wait until you have enough to buy a share of stock, and then they'll issue the shares. So the stock is not issued unless they're paid in full. So let's now take a look at the entries. Entry A is the day you sign the subscription. Debit, stock subscription receivable. Negative, stockholders' equity, unless, of course, it is collected during the post-balance sheet period. You credit this obligation on issued common stock subscribed at par for 6 and the APEC additional paid in capital in excess of par value for the difference. In entry B, you collect the receivable. Incidentally, up here, first entry A, no cash flow effect, but that has to be disclosed as a significant financing activity. Then in B, you collect the subscription receivable, cash flow from financing activities, and then finally in entry C, you've got the issuance of the stock. You simply reclassify the unissued and put that into the common stock or the capital stock. Now, what I want to do is just give you one more look at this. Move it down just one bit. One more look, and let's look at it with T accounts. And put this over here so you can see it. And this will be at par also. So let's take a look at the sequence of events that took place. In entry A, we had a debit to the stock subscription receivable. We credited the unissued common stock subscribed at par, and we credited additional paid in capital. Now, if you don't make that entry, I'll show you what happens in a second. Then in entry B, we collected So we have a debit to cash and a credit to the stock subscription receivable, and that, of course, brings that to 0. And then finally, in entry C, we issue the stock. When we issue the stock, we simply reclass the subscribed account, the unissued subscribed, into common stock. So the net effect, this whole thing, the net effect of this entire sequence, if you look at the entries and look at what zeroes out, the stock subscription receivable goes away, the unissued common stock subscribed account is gone, and the effect is to debit cash for 1,000, common stock or capital stock at par for 6, and additional paid in capital for 4. That would be the entry you would make if you didn't make the first entry, right? So to answer the question, if I don't make the entry, I disclose it, but then when I collect the cash, I would make the entry you see on the foreboard. That's the only entry you'd have to make. Because the net effect of all these transactions, it just, washes out. You're collecting, ask the question again, right here you mean?
Additional daily capital. Collected capital, 600 unissued, 400 installments will take.
All right. Well, I'm saying that this, let me go back for a second. If you didn't make the first entry, and this is, you waited until you collected, this is the entry you'd make. Right?
But the APIC is not the
UT accounts. You're not reporting it until you.
Right. Yeah, you don't record it until you actually do nothing until you collect. Yeah. You just disclose it. So the whole idea, and that's why let's stay with this a little bit more, because the whole idea of the first entry is a disclosure device to put that on the balance sheet so someone sees it without digging through the footnotes. And the same thing happens in employee options. In employee options, you don't do anything, really, on the day you sign the option contract. And here, you have the alternative treatment to do nothing until it's collected. But the footnotes have to describe the potential dilution that results from the unissued shares. This is a potentially dilutive contract. The fact that you promise to issue X number of shares of common stock is potentially dilutive in the market, and it has to be disclosed. So you either disclose it in a footnote or you use this series of entries, which is, again, a much more effective disclosure than the footnote itself. Okay. All right, so those are stock subscriptions. Yes, Sal. Nothing would change in the entries. The balance sheet would simply take the subscriptions receivable out of stockholders' equity and reclassify it as an asset. It's a reclass. It does not change any of the debits and credits, but the category, so what you see here, the account, the stock subscriptions receivable, which is considered negative equity, contra equity, if that happened to be collected during the post-balance sheet period, that would mean that you would have to just call it an asset rather than negative equity. You realize, of course, the cash is not into, for example, let me put this up on the, I'll put it up on the board for you. So, so right now, this is the way the problem looks. You've got, in 2014, you've got stock subscriptions receivable as negative stockholders' equity. If somewhere in the post-balance sheet period, that receivable is collected, nothing happens in terms of cash or anything else in 2014, you just reclassify this as an asset. And that's it. So you would have to reclassify it as a current asset in the event that it was collected during the post-balance sheet period. Cash, of course, stays in 2015, and the shares that are issued in 2015. Now, of course, in the footnotes, you would describe the shares were issued. Now it's a real dilutive effect. Okay, any other questions on subscriptions? All right, so we looked at stock issued for cash, stock issued for subscriptions. Just one more point, then we'll talk about preferred. Non-cash assets. I know we spent a bit of time last semester talking about non-monetary exchanges, and we looked at the commercial substance issue when we had a swap of assets. In this case, we go back to the general rules for non-monetary exchanges when we look at U.S. GAAP. Essentially, what we're going to do, if we issue stock in exchange for goods and services, we're going to value the stock at the fair value of, or the market value of the goods and services received should be equal to what we give up in exchange, which would typically be the value of the stock. If the fair value of the stock is not readily determinable, then we would use the fair value of the goods and services received. So essentially, these are the general rules that you would have with respect to the non-monetary exchange for services and issuing common stock. Now, of course, board of directors sometimes could put a value on this if the shares aren't publicly traded. And under IFRS, it's always valued at the value of the services received. So to give you an example, if you look at the illustration, pretty simple. Somebody does legal work for you for legal work for you. The market value of the shares you give are worth $1,000, so you value the services at the fair value of what you give up. If the shares were not traded, and if you didn't rely on a board of directors valuation, you would then use the value of the legal services. So if the attorney or the legal firm tells you it's worth $1,000, that's what you use. If you don't have stock publicly traded and the law firm tells you it's worth $600, that's what you would use. But usually it would be the fair value of what you give up. Under U.S. GAAP, that's the way we think. Under IFRS, it's different. Under IFRS, they look at it, you should value it at the market price of the asset you get. Now, I always talk about a two-step transaction approach, and this is the way you really need to think, and I know we think this way in finance when we do a sources and uses. Logically, if you had to pay this law firm $1,000 and you didn't have the money and you needed to sell stock to do it, what would you do? You sell the stock for what? Its market price, which is $1,000, and then you give the money to the attorney. So basically, if you took a two-step hypothetical analysis, and we use this, you really should start to think this way for every non-monetary exchange. So what you would do is, first, you would sell the stock. So you would sell the stock by debiting cash, crediting common stock at par for 6, and then APEC. That's transaction number 1. And in transaction number 2, now these did not happen, but this is what you use to evaluate non-monetary exchanges. And the second thing you do is you pay the law firm. Debit legal fees expense, and you credit cash. And in an analysis that's done in valuation or in finance, even though these transactions didn't happen, you'd have a source and use analysis. I mean, basically, what would you do if you were analyzing a transaction and it was non-monetary? You'd say, what's the source and what's the use of the funds? There's always a funds flow here. It's maybe imputed, but there's always a funds flow. So anytime you have a non-monetary event, you should always think about it in terms of two transactions or a dual transaction effect. A hypothetical sale of the stock for cash, and then the use of the cash to pay off the law firm. And of course, very simply, you notice that the cash goes away, right? And essentially the entry is what? Debit legal fees, credit common stock at par, and credit APAC. So that's the way we think of things in the U.S. Under IFRS, the approach is to use the value of the services received first. Then if you don't have that, use the value of what you give up. Slightly different perspective, and you could get some different results. All right, so those are the three ways that we wanted to look at in terms of the ability of a company to issue stock. You either issue stock for cash, subscriptions, or which is ultimately a cash event, or a non-monetary exchange. Any questions on any of those three events or those three transactions? And as I said, for us, the primary driver of covering this is to look at particularly the stock subscriptions and the role that they're going to play in having us understand employee options or stock-based compensation in Chapter 16. All right. Any questions? All right. Let's take a look, and there's the IFRS, at preferred stock. We're going to spend a few minutes on that, just making sure we understand the issues related to preferred. First of all, if you read, I know you can read this, but let me just give you some details. You should realize that preferred stock is probably not a major part of new issues, but it does become important in certain circumstances. So, for example, we know that if you have a closely held corporation, one way to raise equity capital is to use non-voting preferred. So if you think about why these are issued, oops. And preferred is generally non-voting. So a privately held company would not want to give up voting control. This is one way to do it, right? Another thing you could think about preferred dividends are not a legal liability, so you have less risk than debt. If you think about a fixed income instrument, and one of the things you have to think about with preferred stock is the fact that preferred shares are a fixed income instrument where they pay dividends at a fixed rate. So that might be another reason why you may want to issue it. Third, think about the financial crisis. Lots of companies issue preferred stock. Why do they do that? What would have happened if they would have issued equity, common equity? Stock prices were already what? Tanking. So if you needed to raise capital, you can't do that. Debt may have been hard to sell. So, it may be an alternative to equity, to common equity. Should say not less dilutive, it's not dilutive. If not convertible. So, again, it may very well be that, and I know during the recession, the U.S. government bought lots of preferred stock of companies to try to bail them out. I think Warren Buffett did buy lots of convertible preferreds, which he now owns tons of other companies when they now converted to common stock or shares of other companies. So that's probably good range of reasons why companies will issue preferred. You should note the downside of preferred stock is that preferred dividends are generally not tax deductible, so that you lose a tax shield. That's another important point to consider when thinking about the preferreds. Now, who invests in preferred stock? Probably corporations, I would think, or companies or individuals that are looking for a fixed income, because don't forget, preferred shares are considered fixed income. So maybe there's a niche out there. There are some people that want to hold preferred. So dividends are either a fixed percentage of par or a fixed dollar amount per share. So you might see something like this. And in order to have dividends paid as a percentage of par value, they have to be somewhat substantial in terms of par. Let's say it's a 5% dividend rate. So you're going to see this preferred stock listed as either a 5% preferred or a $5 preferred. Now that may sound trivial, but when we get into earnings per share, I've seen this mistake over and over again. You just sometimes don't see it. If it's a 5% preferred, it's 5% of par. If it's a fixed dollar amount, it's the dollar amount per share. So, holding preferred, maybe people that are interested in fixed income, there is a clientele effect where you might have some investors looking also, or why hold preferred, I should say. There's another question. So maybe it's for fixed income. You have to remember also that corporations So fixed income, you could argue, is a downside because you don't get any upside potential. Yep.
It's treated almost like it has a similar common stock, so it can go up.
It can, yeah. It does have some capital gains potential, but in terms of the income side, right. Yep. That's right. Right. Yeah, and it also depends. So Eric's making a good point. It depends on the features. So that if the preferreds are closer to equity, they will move like equity. If they're closer to debt, they may move with interest rates. So it depends. But you're right. I mean, you do get the best of both worlds. You get a fixed income, plus you could get upside appreciation on a capital gain. But you generally, unless the stock is participating, which we'll talk about in a second, you may not get any more dividends than $5 per share. Right? And as I said, corporations will probably hold preferred because of the dividends received exclusions. Don't forget, the fixed income, unless there is a potential to participate with common, could be a distraction for a lot of investors. So I may say, well, I'm looking for growth in income. If I'm looking for growth in income, I generally don't think about preferred stock. I think about income being, blue chip dividends that are paid, and you want to make sure those dividends go up as earnings go up. Dividends can't go up on preferred stock because they're fixed. So you lose that, but after tax, you lose even more. Where corporations get dividends received exclusions, which mean that if they hold a certain percentage of stock, they could exclude anywhere from 70 to 100%. Between 70 and 100% of dividends could be excluded from their taxable income. So they could be getting those dividends tax-free, which gives the corporation an incentive to hold the preferred shares. And the way the dividends received exclusion works, we'll play around with that a little bit more when we look at intercorporate investments. I think I did this in Intermediate 1. Let me just make sure we have an idea what we're talking about here. If Corporation A reports its income, pays tax, and out of that net pays a dividend, if the shares are held by Corporation B, they now have dividend income, and they're taxed on that dividend again. So you're taxed once at Corporation A, you're taxed again at Corporation B, and if there's an individual here, they can be taxed again on the dividend that they receive here. Now, of course, under U.S. tax law, we do get minor breaks in terms of dividends exclusion, but the corporation gets the biggest advantage. So it's possible that Corporation B could exclude anywhere, again, we're talking about double tax, this is multiple tax, right? You're paying tax once at corporate A, paid again at Corporation B, paid again at the individual level. So to minimize this problem, the federal government allows dividends exclusions, and those exclusions here on this dividend income means that depending on the percentage owned, depending on the voting stock held, B owning A shares, now, this is not only a reason to hold preferred stock, but it makes preferred stock more attractive to a corporation than it would to an individual. Yep.
Since we're all young and coming up in CPA firms and what have you, we can set up our own corporations possibly in the future professional association.
Right.
It makes sense for us to buy preferred
Yeah, well, you can exclude the other dividends too. You can exclude even uncommon dividends. It depends on voting stock, but you have to hold enough voting stock. I'm talking about 20%. So yeah, I mean, that 70% doesn't kick in unless you own at least 20% of the other company. What happens is that 20% triggers a 70% exclusion. Once you go over 20, you could exclude 80, and then ownership at 80% is consolidation in tax. So you get 100% excluded, yeah. But that gives the corporation more incentive than an individual to hold preferred stock. Yeah. We'll talk about liquidation preferences. Liquidation preferences are only going to kick in when the corporation is bankrupt. So it's kind of an advantage, but maybe not. You're going to sell it at market. The liquidation preference could kick up the value a little bit, but it's going to depend on the circumstances of that. The liquidation value is in the event the corporation liquidates, the preferred shareholders get paid before common, after creditors, but they could get not only par, but a premium on par, which is the liquidation value. Could get that as well. Yep.
What if a company doesn't go bankrupt, but like a big corporation is split up? What happens if they
Yeah, the liquidation value, depending on the contract, could kick in. Yeah, 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 it could. Sometimes in merger deals, the liquidation value kicks in. Because once liquidation does not only have to be bankruptcy, it could be once the corporation collapses, or at least it's no longer an entity. Right? Yeah, it's good questions. And then, of course, there are other features of preferred that make them marketable. So if you think about why holding preferred, don't forget preferred could be redeemable, convertible, or participating. So preferred stock, in order to make it marketable, there are possible features of preferred stock that make it marketable. So, for example, it could be convertible into common stock. It could be redeemable. We're going to talk a little bit more about redeemable, but simply redeemable preferred means that you have the right on certain dates to cash those shares in, and it's almost like debt. It has a maturity date. So under the contract terms, you could, in fact, walk into the corporation with redeemable preferred stock and demand payment. It's got a maturity value. Cumulative preferred we'll talk about in a second, and participating preferred simply means that not only do you get your fixed percentage, but there's a chance you'll participate with common and get a higher dividend rate. So you could participate with common there as well. Now, these features all are designed to try to help you get more people to hold preferred stock. Okay. So again, convertible we'll talk about in chapter 16. I'll show you a little bit about redeemable, convertible, and participating in this chapter. All right, so that's the introduction to preferred. Just getting, and as I said, we've got one finance class, we don't have corporate finance, so we have to do a lot of corporate finance here, as well as a lot of decoding or a lot of analysis as well. So this is sort of the corporate finance side, at least some definitions and a little bit of the rationale why we issue. Now, here are the preferences. Why do we call preferred preference or preferred stock? It has priority over common as to dividends and assets in liquidation. And when we look at the dividend preference, first of all, the preferred stock has to be, or the dividends have to be declared. So it simply means that if dividends are declared, preferred shareholders will get dividends before common stockholders. But if dividends are not declared, there is no liability to pay those dividends, even if the preferred stock is cumulative. Now, what is cumulative preferred stock? Give you an example. If dividends are not declared, and let's take our dividends are not declared. Dividends are passed by the board of directors, but you've got that contract, a fixed dividend contract that says the par value is 100, the percentage is 5% or $5 per share. Dividends are not declared and they're passed. If the dividends are coming from a cumulative preferred stock, this is known as dividends in arrears. Now, dividends in arrears are not a legal liability. It simply means that if dividends are ever declared again, they must be paid to the preferred shareholder first. So this is not a legal liability unless it's declared. So let's make sure that's clear. So it's not a legal liability unless it's declared, but it must be disclosed. And I would say it's almost like a contingent. It's similar to a contingent liability. Why? Well, if dividends are declared, got to pay back the dividends in arrears first. Now, there's a couple of things that you have to consider. Number one, why is that disclosure important? Who needs it? Investors. Why? But from the standpoint of a common stockholder, either a current or a future common stockholder, that tells me that I can't get a dividend until what happens? Those got to be paid back first. So the risk you're talking about is the risk of no dividends. I can't expect a common dividend if dividends in arrears are not paid. And even for preferred stockholders, I mean, obviously these have to be paid first before the 2015 dividend can be distributed. So it has to be disclosed. The other critical piece of this is that when we look at earnings per share is applicable to what class of stock? Common, preferred, or both? Earnings per share. Common. It's only applicable to common. And the earnings that are available to common include net income. Net income is already reduced by one form of cost of capital, which is what? Interest, debt interest. Are dividends expenses? Not in all cases. Most cases they're not. So what we need to do is subtract dividends, preferred dividends, from the net income to determine how much common stock has the right to. Dividends in arrears have to be included. So for the 2014 earnings per share, I have to deduct $5 for dividends in arrears from the income that's available to common. Now, this may not seem important. It may look like a definition to you. Take a look at an earnings per share question that we're going to go through. If I say dividends are not declared and you forget that the common stock, the preferred stock is cumulative, you're going to leave off the preferred dividends. Preferred dividends have to come off common stock if they're declared or if they go into arrears on earnings per share. So this is going to be a critical piece of what we need to know when we get into the earnings per share calculation. So dividends in arrears are not a legal liability unless it's declared, and of course it is a important piece of an investor's decision making, therefore it has to be disclosed because it is a contingent liability. And it's going to affect us in a very, very significant way when we look at earnings per share. Now, the other preference is going to be that liquidation preference. And again, the liquidation preference is going to be if the company liquidates, or as we said, if it sells the company, the liquidation value sometimes will kick in depending on the contract, which means that if you have a par value of 100, its liquidation value let's say is 105, and the liquidation premium is 5. So that in the event the company liquidates, or if a company sold off, or if it's collapsed in any way, that company, if it has a liquidation value, it must be disclosed. It means that after creditors are paid off, any assets that remain go to preferred, and preferred not only gets par value, they get a premium on par if there's a liquidation value. Now, I mentioned in modeling, if you do financial modeling or valuation, one of the most important things to think about is whether or not preferred stock is considered debt or equity. And in a lot of ways, preferred could be considered a hybrid. We're going to spend a lot of time in Chapter 16 looking at, I guess, the corporate finance side of hybrid securities, how to value them on the balance sheet, not in the market, but on the balance sheet. And if I'm valuing a company, I look at its aggregate value. Its aggregate value is sometimes called its asset value or its enterprise value. And take a look at this. It says it's equal to equity plus debt. I mean, that's nothing more than assets equal equity plus liabilities. But I want you to see what net debt is. Net debt is the sum of debt plus preferred minus cash. So in most financial models, preferred stock is considered to be debt. And that will depend on lots of features. And depending on the scenario, and Charles, you brought up a scenario, and Brian also, if a company is going to be sold, not necessarily liquidated in terms of bankruptcy, probably in the net debt calculation, you're going to use the liquidation value for the company. So this means that preferred stock in most financial models is treated like debt depending on its features. So first, let's look at the debt characteristics. So I think I mentioned this last semester when we looked at Chapter 5, when we looked at the balance sheet. When you look at a corporate finance textbook, there's always a chapter that gives you a spectrum of securities. And looking at debt on one side, equity on the other, preferred stock can slide along that spectrum depending on its features. So we know that it's got a fixed percentage, fixed income looking like debt. Par values can be non-trivial because you need to multiply a percentage against it, so that makes it like debt as well. Preferred shares are typically non-voting, and here's the one I wanted to make sure we covered. Preferred shares could be redeemable. This means that redeemable preferred stock tells the stockholder that at certain points in time, they could bring the shares in for payment. They're essentially preferred shares with maturity dates. On those maturity dates, the corporation has to pay the par value or maybe even the liquidation value, depending on the contract, for those shares. Now, for years, accountants debated where this goes. SEC said you couldn't put it in stockholders' equity. On U.S. GAAP, we used to dump it in between liabilities and stockholders' equity. Now we have to report it as debt. On the U.S. GAAP, it is reported in the debt section of the balance sheet. So redeemable preferred stock is long-term debt. It is not equity on the balance sheet. And we finally became consistent. There was a time we were inconsistent. Dividends are expensed on the income statement. So for redeemable preferred stock, it goes on the balance sheet as long-term debt, and the dividends paid on redeemable preferred shares are debited to an expense account. They're usually included with interest expense. Now, IFRS has been doing this for a long time, and US GAAP, what makes US GAAP difficult is the fact that we have rules for every specific type of security, every type of transaction. IFRS is much broader. All they say here is anytime a payment is outside of the control of the issuing corporation, it's debt. Simple as that. If any payments, whether it's interest, dividends, or principal, if those payments are not under management's control, in other words, they're under the control of the shareholder or the security holder, it's a liability. That's it. It doesn't have to be a preferred stock. You don't care if it's debt. Whatever the security is, if the payments are determined by the shareholder, then it's debt. So we get the same treatment here with IFRS and US GAAP. Redeemable preferred stock is long-term debt, and the dividends on the redeemable preferred are in fact considered to be expenses. Now, that's the debt side. The equity side is, of course, it is legally equity. It could participate. Participating preferred stock simply means you get your $5 per share, but you could also share with common in some ratio. So for example, if you get your $5 per share and the rest of the dividends go into common, if you're a participating preferred shareholder, you could share with common on some ratio, either the ratio of total par values or based on market value. Something will be in the contract. So you'll get your fixed percentage plus you'll share with the common stockholder. We also know about convertibles. We're going to get into that. Convertibles can be either a specific or an embedded convertible in the contract, and these shares would be potentially dilutive, and of course the preferreds could have voting rights, and in a lot of cases a contract that has cumulative preferred stock, if dividends go into arrears under certain cases, as soon as dividends go into arrears, the preferreds become voting until the back dividends are paid. So if you have a cumulative preferred stock, and in that contract it says that if dividends go into arrears, the shares become voting until the back or the arreared dividends are paid, then you have voting rights. Typically they're not voting. Now, the question is, where do you report these? And from an analyst standpoint, I know where we report them from an accounting standpoint, but from an analyst perspective. Let me tell you again, I'm always saying this, that yes, calling redeemable preferred stock as debt is much more transparent. But will an analyst always consider this debt in their models? Depends. It's going to depend. What if the redeemable preferreds, and I'm not, as a corporate treasurer, I'm not going to make a mistake here. If I make those shares redeemable, what other features do you think they're going to have? Probably convertible, right? I'm going to want you to convert before I'm forced to pay out par value. So I'm going to hope that you convert those shares to common stock before I have to pay you face value. I'm also going to have a call feature. What does the call feature tell me? That if you don't convert when, let's say, stock price goes up and it makes sense to convert, I'll call in the preferreds. If I call them in, what does it mean? It means you've got to give me the face value. Your stock, either you convert to common or I'm going to give you par value. Or maybe a liquidation value, but you're not going to get perhaps as much as you would if you sold the stock. So in those cases, as I start pushing the preferred closer to the equity side of the spectrum, I don't care what the accountants call it, I'm going to put it into equity. And this has always been the case. So whether accountants call this equity, whether they call it debt, whether they dump it in accounting limbo between accounting between stockholders' equity and debt. Doesn't matter. The people using the statements that understand the nuances will classify it as they wish. However, this is much more transparent. It's much more, I think, economically sensible to show the redeemable preferred as debt, and of course and just using this as an example, using the interest or the dividends as expenses. Okay. All right, now common stock, real simple. Not much going on with common. Pretty clean. They only get voting rights. They have the rights to share in profit and loss, and they get preemptive rights. Now, preemptive rights are going away. I'll tell you why in a second, but first, what is a preemptive right? A preemptive right is the right that you have to maintain your proportionate interest in the corporation. So that if you have a 20% ownership of the company issues new stock, you're given the right to buy the first or buy enough shares to maintain 20% of the company. Now, sometimes those rights are pieces of paper that you could sell to somebody else. You have to realize that lots of companies are buying up shares that have preemptive rights and replacing them with shares that don't. In Europe, the General Assemblies, or what you would call stockholders' meetings in the United States, are voting to eliminate the preemptive rights. The reason for it is because if I'm doing a merger deal and I have to issue stock to buy your company, if I have to issue new shares to buy your company, I've got to cover all the shareholders I'm buying out, plus I got to cover your preemptive rights. So it makes the deal much more dilutive, and therefore these are not very favorable provisions for common, and they're tending to go away over time. So they're there in some cases, but they're starting to become less and less popular. All right, so before we go, let's get time for a couple of questions. I'm going to ask you two questions. You don't want to answer the questions? You don't want to answer the questions? I heard people. Oh, okay. All right. Oh, okay. Let's ask them. Let's do the first one. The first one. Actually, we have 2 minutes, and I've got two questions. All right. So the SEC, question number 2, requires that companies disclose their dividend policy in the annual report. A is true, B is false. And you have to stick around after anyway because we have a vote coming up at 1:05. All right. Why did they come up? Let's see. There it is. Okay. All right. So the question was whether or not the SEC requires, and the answer is false. I mean, it is correct that B is the correct answer. The disclosures on dividend, now you have to disclose the dividends paid, but all those disclosures we looked at are recommended by the Securities and Exchange Commission, so they're not required. Now, that's not really the thrust of this question. I mean, the thrust of this question is really what those disclosures do and why do companies voluntarily make those disclosures and why does the SEC recommend them? Reason? Stability, right? Stock price stability, especially on dividends, to know that a company pays a stable dividend over time. It's also important, if we think about those other disclosures, how the market reads those buyback plans as being favorable, and they do pay a premium for companies that do provide you with those significant disclosures. Okay. All right, let's do one more. And again, I would have... And the other ones, as I said, pretty much more definitional, but this one is something that I may ask on an exam type question. So let's do number 5. Stock subscriptions receivable, classified as a current asset on the balance sheet. Okay. A is true, B is false. All righty. Well, see if everyone's in. Okay. All right, so everyone got that one right. The other class did the same thing. Okay. Now, that is correct, but you could have answered true also. And of course, the false answer, which is correct, gets you 0 points on the exam. Now, I've got you all on the hook because you all answered B, or false. Why?
It's negative equity, so it's not legally enforceable.
Right.
As a collectability is uncertain.
Right.
It's not a part of the whole operation.
Right, okay. But, however, that's so far you get about 7.
But it's true if you collect it post-balance sheet.
There you go. Okay. That's it. So now you got 10 points. So that's it. That's it. You got 10 points. All right. That's the way you're going to answer that question. All right, great. So we did okay on that one. All right, now, vote. Got another one coming up. Leaving the, let me get this out of here.